Hi there! In this video, I'll be presenting Societe Generale, which is a top-notch financial institution that boasts remarkable fundamentals, making it a prime target for investment. So this is an attractive company, and I intend to take this opportunity to really showcase the overall strong trends that Societe Gen, like many other banks, is currently seeing. The bank has absolutely outperformed to the tune of some 20% rate of return in less than 6 months and 12% in this last month alone. So let's see 2023 period. The 2023 earnings period looks good for the bank, and in this video I will present you with my thesis for the year and why I think Societe Gen is still a company I would buy. Now, let's first look at strong results. Societe Gen is, despite what some people say, a qualitative European bank, and it's even getting better. During third quarter of 2022, reported cost-income ratio went down to 60.7% from 61.5%, and it's starting to touch sub 60%, which would be among sector leading. The company furthermore improved its overall revenues and still has a solid 13.1% common equity tier 1, which is below Scandinavian banks, but it's still fairly solid and has developed on many of its strategic ambitions going forward. The bank netted nearly 860 million for the 9 months period of 2022 and is accelerating the decarbonization of its overall portfolio with significantly lower exposure to oil and energy, specifically the upstream segment. Its new target is to lower it by 20% by 2025 with a 30% reduction in 2030 based on 2019 levels. The company isn't leaving the segment, but it's pushing forward. I don't consider exaggerated ESG to be a massive advantage, but I thought I'd mention it since I just had a course in sustainable finance by Stefano Battisson. Um, I think he is a world-class expert in this field, and I think he is also the second most cited expert in sustainable finance. So let's look at some trends. Here is how the trends are looking for the bank currently, and these trends are very solid as I personally see them. Despite only small increases in gross income, the company has been able to push down costs further. The company has performed exceptionally well, as evidenced by the 9-month financial performance in the year 2022, with a cost-to-income ratio of 59.6%, which is below the target of 60%. Remember before when we were saying that it was 61 point something? Now it's already below 60%. This is due to the company's continued discipline in controlling costs related to variable compensation, spending on facilities, and other factors. Revenues are up 10.4%, but costs are up less than 5.5%. This is excellent. The bank's continued cost of risk is also low, and despite more uncertainties, the bank's NPLs, which are non-performing loans, are actually down. What was once 3.4% during late 2020 is now 2.7%, and the cost of risk for the group is less than 36 basis points. Defaults are still low, with a cost of risk not exceeding 160 million in stage 3 defaults, and at the same time, the bank strengthening its provisions in case things get worse. Societe Gen is doing all the right things, remaining conservative, pushing up provisions, but staying the course. The only fundamental thing I I think could be somewhat better would be common equity tier 1. As I said before, most European banks or Scandinavian banks have far better, even if I can't find or see any issues in the funding, the buybacks, the leverage, or anything else. So it would just be nitpicking. On a granular level, there really wasn't any underperforming Societe Gen segment. Loans and deposits are up, and the company's insurance business continues to show good trends. hope I'm not gonna butcher this, but Boursorama has more than doubled its onboarding of new clients and is up 40% to 4.3 million clients with loans growth and a 37% deposits growth alone. Retail banking is up and international banking is also up. Now, remember, the company has a non-trivial Africa segment, which saw loan and deposit growth as well. Meanwhile, global markets and services delivered strong performance despite a very volatile environment. Now, if we look at global markets, the company continues to operate a very strong advisory and financing arm, with revenues up despite the market uncertainty and good activity in asset-backed product sales. Global transactions and payment services especially also showed very good growth, up 50% on a quarter-over-quarter basis. Societe Gen remains one of the safest and most interesting banks on earth. Take it with a grain of salt. I don't typically highlight ESG, but let me at least give you this because it might be relevant for some of you to see how far the bank has come in those ambitions, and that is in fact leading the charge here. So you will find the bank represented across the entire world. Societe Gen has an S&P rating of a Moody's rating A1, and a Fitch rating of A+, as well as many other high credit ratings. These are all top-notch scores and is better than many Scandinavian banks, despite the common equity tier 1 we saw before. If you start looking through the bank's material, you'll find a great deal of focus on compliance training, staff education, and how the bank intends to work with its management to ensure not only good but safe performance going forward. Given the bank's 7-year history, this focus is understandable. Now, compared to its peers, Societe Gen has one of the lowest risk, the lowest non-performing loans, and the lowest risk-related metrics overall. Despite France having a couple of interesting banking peers, Societe Gen remains my favorite French banking investment. Societe Generale does have a somewhat troubled past due to hundreds of millions in fines to the European Commission, to Fannie Mae and Freddie Mac, and to settle charges of fraudulent conduct. The bank also paid 60 million to the OFAC for violation of US sanctions. This is basically why the company is investing so much in training, in part as a window washing sort of measure, but also to truly ensure that its operations going forward will be compliant. It was one of the banks that took the longest to emerge out of the financial crisis. And if you recall, I do, though I wasn't an investor at the time, the a British paper called the Daily Mail posted an article announcing the bank's bankruptcy, and this caused pressure on the bank's stock for almost a year due to speculation. The bank successfully sued the paper for this, but the share still lost nearly 60% of value in 1 year, which illustrates the power of speculation and media and the power you could have if you invested in undervaluation. So kind of crazy that one thing in the news could cause such a disruption in the stock price. Now let's see, do you think if Societe Gen is undervalued? Well, me personally, I think so, but in short, it's sorta. The golden opportunity to invest in Societe Generale presented itself between September and November, when the company was undervalued and had the potential to soar by 20% or more. Although the company still holds some promise for growth, it's like settling for a half-empty glass instead of enjoying a full pour when the company was truly a bargain. When looking at Societe Generale, we have a historical performance working against us at this time. The dividend payout and stability, in my opinion, are a joke compared to other banks, and insofar as general dividend stability and safety goes, it really doesn't exist. 1 year it's there, the next one it isn't. But the key here is that historical performance is far less reliable and qualitative than future performance. So, what are my expectations for Societe Generale? In dividend terms, I don't think there is dividend stability, not yet, but the trends in earnings per share stability are improving, as well as we look forward, and underlying trends are far more solid than they have been in the past. The analyst price target is as follows. So we see that overall it is a buy. Societe Generale has been on the radar of analysts for several years, with a price target ranging from 24 to 40 euros. Although the average price target has fluctuated slightly, it remained in the 32 to 34 range and currently stands at 32.5 at the time of recording this video, with 20 analysts following the company. Despite the consensus, the company remains undervalued compared to its peers in the multinational and global banking industry. With a forward PE ratio of 6 times, this discount may seem excessive given the company's recent success in turning its fortunes around after the financial crisis and navigating the COVID-19 pandemic. But here's the real perk. A forecast dividend estimate of 1.84 euros equates to a yield over 7%, which is huge. This is a high number in comparison to its peers, even when taking into account France's structural limitations and specific taxes, which my European viewers might know. So, despite this, the bank's quality metrics continue to shine and make it a compelling investment opportunity in the current environment. Now, my stance is bullish. For that reason, my stance on this remains bullish as before on Societe Generale, but that's because of three things. The recent term results, which indicate a positive change, and a new covered dividend, which is looking solid. Solid fundamentals based on strong economy and market-leading brands, and forecasts for future results, which are also positive. The bank, due to non-reoccurring effects, had a gangbuster 2021 fiscal and is now going into 2022 earnings with lower expectations, but is expected to move back to growth in 2023 earnings. Even assuming a 6 to 8 times PE for the bank on a 2024 earning basis gives us annual growth of 16.20%, resulting in near triple digit returns on a 4-year basis. Any reversion to the 10-year average of 11 times PE results in a 4-year returns of over 130%. And such valuation isn't at all unusual for this bank. And remember, when I'm presenting this results, like my thesis, I am being conservative. Now, the thesis for the common share, let me repeat, Societe Generale is a top-notch French financial institution that boasts remarkable fundamentals, making it a prime target for investment. With a favorable rate environment and positive earnings trajectory, I firmly believe that investing in this company at the right price point is surefire way to achieve alpha returns. Now, recent results only serve to strengthen this bullish outlook, solidifying my conviction in the company's potential for growth. At such low valuation, I highly recommend purchasing Societe Generale with a price target of 30 euros per share. Don't miss out on the chance to invest in a class-leading financial institution with excellent prospects for the future. Even though the company has been silent since the financial crisis, I think now it's a good opportunity. With this, I end my presentation and this video, and I hope you enjoyed the video, and I'll see you next time.